MMAT, we believe all along, even we still are in the red. Oh, MMAT, please, Georgie, give us some to believe. Oh, the FTDs isn't like an STD. It's like the SEC giving you the D. Oh, please, Hadji shorts, don't cover before Thursday. Oh, we are here for the double squeeze. Hey, what's up, guys? This is Diligence here. I'm so sorry that I supposed to push this video out yesterday, but then due to last night I got a fever and then didn't really feel that well, so that's why I just went to sleep. And this morning I feel not super well. I'm just feeling better, so I'm gonna finish this video and push it out. I had a sore throat. I don't know what happened. It might be the traveling. It might be, the hedgies and the government trying to catch up to me and trying to do some chemical warfare against me. I don't know. Speaking too much of the truth. And in this FTD video, there's some harsh truth that you guys need to know. And I'm going to tell you guys. And after this video, not in this video, in the next video, I'm going to start making basically start making a probability distribution for the probability of a double squeeze based on the data we have on hand. And what is harsh about SEC and the data that we can get from the SEC is they usually have a 5 to 10 day delay, even for fail to deliver, because they sort of give you packages, and their packages, the cutoff line is like every 15 days. So in order to really know how much they actually shorted or they actually failed to deliver, you need to wait for 15 days. Which this is one of the reasons the market is very inefficient right now. A lot of you are saying, oh, American market is very efficient. No, that's totally not true. The market is very inefficient. And a lot of overshorting situation always happens because the 13-day clearing cycle actually creates a lot of problem. But I'm going to sort of just touch on that in this video, or maybe not, because it sort of, I don't really want to get political, because even though you said stocks or Dodd-Frank, for those of you who sort of been in the finance industry or in banking industry for a while, you're like, oh, that's pretty good. It sort of, stopped deregulation going on. But the truth is, we're still using the paying for option flow from the Bernie Madoff era, and we're still using a lot of the very old sort of stock matrices and stock data matrices, and a lot of the shorting mechanics and a lot of the shorting contracts are a little bit outdated, and how mechanics, like in terms of where the mechanics should be, this should be, how to say this in a better way, it's like the hedge funds needs a reform, okay, in order for the market to be healthy for the retail player. I think the legislation or legislative forces for the hedge funds and for the mechanics of short selling needs a reevaluation. It really needs taking another look at it, because a lot of them actually manipulate the market. But if you sue them for market manipulation, all the things they've done are quote unquote legal. So anyways, let's get into this today's video. Yo, let's start today's presentation. It's going to be fairly short, hopefully. Hopefully I don't really ramble. So today's objective, we got to talk about FTD, which is fail to deliver. And what the heck is threshold security list, right? Like what gets you to place on them? Is there any penalties? Or there is written penalties, but not really any penalties? You know how all these attorneys works, right? A lot of these legal terms are so hard to understand, so that the common people won't even read it. Before I start this video, first of all, we are not financial advisors. We do not give any financial advice, okay? And everything on this channel is for shits and giggles only. And of course, we are also not attorneys. So a lot of these interpretations for the SEC rulings or SHO rulings are purely personal opinion and purely educated personal opinions. So take these information at your own risk. All right. So what is fail to deliver? Under Rule 204A, all fail delivers positions in equity securities resulting from shorts or long sales must be closed out by borrowing or purchasing securities of like kind and quantity by no later than 9:30 a.m. on a T+3 basis. Okay, for the short sellers, and on a T+5 basis for the long sellers. Any fail to deliver position that is carried beyond T+3 or T+5 will result in a violation of Rule 204. But, if you look at this, right, there's no such thing as monetary punishment or anything other than if the fail to deliver position is not closed out by the proper time by borrowing or purchasing security of like kind and quantity, IATG must place a relevant security on the restricted list for no short sales allowed. The security can be removed from the restricted list only after purchase have cleared and settled as a registered clearing agency. So just from this one rule, we already find a lot of loopholes, okay? So here, this is one loophole. So basically, if you are in a violation, there's no monetary punishment other than the agencies, the clearing agencies, or whoever's in charge of figuring out whether they should close their position or not, or in this case, probably shorts prime mortgages or shorts themselves. So what happens is these mortgages are like, okay, guys, you cannot short anymore. So the punishment for this is you guys cannot short anymore for the short sellers, right? So there's no shells allowed. And then they're going to be put, and then later in the video, I'm going to tell you that if it's for a, say, public traded company, a big one like AMC or MMAT, they're going to be put on the threshold security list after a consecutive period of time that they didn't deliver. So fail to deliver is like situation A, okay? Literally, if you fail to deliver, there's no literal punishment other than you cannot short anymore, and then it sort of triggers a settlement cycle to come. So yeah, this is unfair, isn't it? Also, there are other loopholes, okay? You can close out by borrowing or purchasing security of like kind and quantity. That means you can actually borrowing or purchase security, not just the security itself, but you can have any security of like kind and quantity. This is very interesting. For those of you who are in the field of law, you guys understand that like kind and quantity doesn't mean I shorted MMAT, I have to buy back MMAT itself. You can buy back certain things to sort of prolong the cycle of when you have to close, sort of push it back a little bit, which means you haven't directly purchased or borrow the securities to close out your position yet, but on paper you already have. Alright, if I haven't explained it very clearly, please let me know, because I know my brain are kind of fast. That's why by explaining stuff, sometimes my brain works way too ahead. So then if any of you have any questions regarding this, please comment down below. And number 2 and I are going to try to read every single comment, which we do, right? Which we did. Just like these 2 days or 3 days, I've been traveling and I'm a little sick right now. I'm feeling way better. So yeah, next slide. So the visual representation here is, let's say number 2 is the short seller. And then he got a notice from his brokerages and it's like, oh, oopsie. I guess I need to get those shares back somehow, but not right now, right? I at least have another 3 days to do it. And let's just see what happens if I don't do it, right? And the little penalty for him is, guess I just can't further short anymore. And guess what? In here, it just says you cannot further short. Does it mean you cannot using options to short? No, it never said anything like that, right? And, and as we all know, if you are seasoned hedge fund, you know that if you cannot really short the stock directly, you can even buy puts. You can just buy loads and loads, mega loads of the puts, and what you can do is you can like keep selling calls, right? Because for them, in order to hedge, they sort of have to have a certain amount of stocks in their hand, and they can just sell a bunch of calls. They can just buy a bunch of puts. There's no really penalties, and by doing that, a lot of you who are tracking the IV and live, option pool, you will know that. And a lot of all these websites and articles can talk about, oh my god, there's irregular option flow. People are buying puts. That's why people are bearish on the stock, right? And a lot of retail is going to listen to them, and they're just either going to dump all their shares because they believe that the stock is going to keep going on, or it just creates a spiral panic attack, right? See? But these are not counts as market manipulation, guys. These are counts legal, okay? Playing with other people's mind and emotions and psychology on the market because you have a lot of money and you can just stifle them because you have a lot of money, apparently it's legal. Guys, don't be too salty about the statement I just made, okay? It's okay, because one day, our YouTube fund or whatever, once we reach like a bunch of subs, then maybe we can start something similar to that. But we're probably gonna be way more ethical than the bad hedge funds. We probably will be the good one. But eventually we're gonna have enough money to sort of not manipulate the market, but influence the market in a good way, trying to be ethical and investing all these companies that have potential, like George's company, right? But another thing about MMAT is the PR is absolutely horrendous, okay? And look at the stock price right now. Number 2 and I were actually trying to, we already filmed our Dear George video, right? But we think it's sort of missing something. But right now it seems like it's very urgent, so we probably should send it out as fast as possible. And shout out to our little elf friend who is helping us with editing and with sort of giving us feedback on what people in George's age would love to see. But right now, let's just talk about what happens if you don't sort of close out your position on time. So what happens is if you're on a fail to deliver list, or you have a significant amount of shares that you fail to deliver, and you didn't close out your position on time in a T+3 cycle, what the SEC or SHO is gonna do is they're gonna put you sort of on a settlement date, a settlement cycle, and after the settlement cycle ends, you have to, quote unquote, you have to cover, you have to close out your fail to deliver position, okay? And in this case, the settlement cycle is 13 consecutive days. So if for 13 consecutive days you are on the fail to deliver list, that means on the 13th day is the final day that you have to settle your position. Okay, that's very clear, right? So basically, day number 1, you fail to deliver. Day number 2, you fail to deliver. Day number 3, you fail to deliver, blah, 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 until the 13th day. On the 13th day, you have to cover. You have to deliver, all right? So a visual representation for this is, let's just say number 2 is a short seller, and he failed to close out his stuff, failed to deliver stuff. And he just triggers a 13-day settlement cycle countdown, right? So for him, he's going to be like, swag, dude. I still have 13 days to finally settle. I'm chilling. Because you know what? 13 days is a long time, guys. You know the 13-day settlement cycle is actually a joke. Because literally every month there's going to be a fad minute. And if every fad minute is like the fad minute we had last Wednesday, so I mean within that 13-day settlement cycle, these shorts can have a much less expensive price to cover. And they might even get a really great deal, because at one point they probably don't even need to cover anymore if people just panic selling and panic selling and panic selling, But this thing didn't really happen to AMC for this cycle, really. I'm gonna talk about this in my AMC video. AMC is really a tragedy, okay? Last Wednesday's Fat Minute literally annihilated AMC's sort of near future squeeze potential, really. It's a very sad story. I'm gonna dedicate another video about it. But this video is sort of like, it's like an introduction to how fail to deliver sort of squeezing really works. And maybe later on I can make a video about how gamma squeezing mechanics really works. But gamma squeezing is a little bit more complicated. So let me know, guys. Just leave a comment down below. And for fail to deliver sort of squeezing mechanics, it's much more easy because you have a set time frame. For gamma squeezing, it's literally 50% luck and 50% how much volume you have, and sort of you have another like in a limbo sort of possibility that the market makers haven't really figured out or haven't have any contingency plan for very out of money options, right? But anyway, so for here, short sellers like swag, I still have 13 days to finally settle, and within that 13 days, who knows what's gonna happen, right? And if there's a day where the market just dropped 5%, or our friend Jay Powell to tell everyone the market trajectory isn't gonna be that great, or people suspect the market's trajectory isn't that gonna great, the interest rate might rise in the near future. Bam, market goes down and people panic selling. I guess we're just gonna get a really great deal from people panic selling, right? So literally, I think it's not like the government is helping the shorts. It just the 13-day settlement cycle. I think it's just way too long, really. And a lot of us are day traders. So then for day traders, 13 days is a long time. You only have, in a week, you only have 5 trading days. 2 weeks is 10 trading days. How many weeks are there in a month? You literally have you only have 20 trading days in a month, and 13 days out of 20 times 5, that's like literally 65% of a month is already gone. And usually, if you look at the normal distribution of how price action works in a month, within that 13 days, there's always going to be a local mean. And then if the hedge funds are smart enough to sort of cover in a local minimum, that means the money that they lost is just so minimum. And then the reason why the AMC short movement was kind of successful on June 2nd is because it was a sneaky attack, okay? It was a sneak attack. The hedge didn't realize that the apes are sort of just like very strong holding and holding it, right? But those sneak attacks only works for one time. And once the hedge funds adapt, look at every single Friday after that sneak attack, no gamma squeezing, no nothing, right? Because the shorts and the hedges already learned, and they already adapted the way how retail players sort of trade. That's why love Trey, love Matt, but the fact that they don't really have a lot of financial background makes it really hard to sort of further trigger a bigger squeeze or further trigger a squeeze that will eventually make everybody multimillionaires or millionaires, right? So sorry, I'm not trying to be salty, but I'm just saying, like, I don't have that much of viewership, so no matter how much I know about the market, it's sort of like I can't really help you guys. Not really help. I don't know what is the right word to do it. It's more like, even if I educate you guys, we only have 1K, 1.2K. Maybe by the end of like next week's gonna be 2K people. At 2K people, everybody spend $1. It's 2K dollars. It's like nothing, right? Even $100, it's nothing. But for people like Matt or Trey, they have like at least 50K subs or 50K sort of people who constantly watch them, and even just everyone spent $1. If they just educate them a little bit and telling them, okay, there's a huge difference between if you buy an options or buying the actual stock. If you buy the stock, it's much more useful in terms of triggering a near-term short squeeze rather than buying options. Then hey, maybe there's going to be a short-term squeeze potential. But they don't. They usually just tell you, all right, this is the price point we have to hit, and just buy and hold. Anyways, I think I'm just being a little salty, and I guess the fact that I had a fever last night kind of make my brain a little bit gibberish and into sort of like a mashed potato. But anyways, next slide. So after explain failed to deliver, and also little things about the loopholes failed to deliver. Also, we talked a little bit about why AMC doesn't really trigger a near-term short squeeze after June 2nd. We're going to talk about threshold security. Also, we talked about settlement cycle, right? Settlement cycle is kind of a fairly important concept here. So all you have to know for a security to be on a structural security list is A, the security itself has to be sort of like heavily traded, not a penny stock. It's sort of categorized under the Exchange Act, which just means a lot of people trade them. It's on a big exchange like NASDAQ or NYSE or something that people just regularly trade, and they have to send their shareholders monthly, daily, not really daily, monthly, yearly, or quarterly reports. For example, MMAT will be one of them. AMC will be one of them. And in order to be on a structural security, the stock has to be on a 5-day consecutive settlement day cycle. So it means if for the 2 days fail to deliver, fail to settle their fail to deliver position, they trigger the settlement cycle date, right? They trigger the settlement cycle countdown. And then for 5 consecutive settlement days they haven't covered yet, the security is going to be on the threshold security list. So let me give you guys an example, okay? So for AMC, they first appeared on the threshold security on June 25th, right? As we talked about before, according to the rules, that means on 25th, they're already being on sort of like the no short selling list for at least 5 days now, right? In order to be on a threshold security, you have to be constantly on the settlement cycle, the 5-day consecutive settlement cycle, which means at least 2 days before that settlement cycle even triggered, that means the shorts are already sort of heavily or over short selling a lot of the AMC shares. Okay, there's a reason behind that. If we look at the charts here, so this is Friday the 25th. Okay, so on that Friday, right, if you look at Trey's or Matt's YouTube channel, you will know that they're right on this one. They're saying we have to be over $60, okay? So if AMC stays around $60, that means on that Friday, there's going to be a short squeeze. And on that Friday, if the short squeeze happens, the stock is going to be over $82. And I didn't make a video. I don't think I got time to make that video, but in that video, I was going to talk about the objective of the hedge fund on that Friday. The objective of the hedge fund on that Friday is no matter what, they have to stop AMC reaching $60 by the end of the market close, which they did. By the end of the market close, it closes at 59.64. If it just move up another 36 cents more, there is going to be a squeeze. But it never happened, right? So if you look at the day beforehand, that means this is already overshorting. If you look at this chart, look at this candle, right? 12 million shares battling on this candle right here. That means the hedge fund doesn't want you to push it higher and higher. That's why they short, they short, they short, they short. If you look at all of these volumes, they shorted a lot. And if you like, and you know, retail pushes up, and they shorted a lot. Retail push it up, push it up, push it up. They short and push it up, push it up, push it up overnight, right? And then you look at the 25th. You see, opening up, a bunch of retail coming in. Oh, pushing 64. Nope. Hedge funds like, no, we can't let it be over $60. Let's just short it. And because technically on that day, they already failed to sort of settle their fail to deliver. So what they can do is they can actually utilize options to short it. So they utilize options to short it, to short it. But also in reality, you guys gotta understand that the prime brokerages and the hedge funds are friends, okay? And even if they trigger the settlement cycle, what they can do is they can sort of be like, okay, I have a contract with you, and I will eventually find you a cheaper share for you to cover within X amount of days, okay? And because there's no SEC ruling or law to prohibit them to do it, that means they can't. So if they actually work together, they can literally together drive down the price by a lot. And you can see over here, and then around this 720 point on Friday, you know, everybody watching streams like, oh my god, I gotta buy. It's like $61. Buy. And then buy until like $63. And because $63 is literally a support line, and then you should have push. But the hedges will probably sell, right? They probably will sell their their lower price point acquired stocks. So then they sell, and then somehow we sort of push it back by $63. And a lot of people will probably just reap a little profit over here. This is not hedge funds. This is retail, right? And also these are probably retail. So retail started selling. Their understanding will probably just be like, okay, as long as it's over $60, we're okay. And then around $61, right? People are like, oh, let's just buy some more. But you see, if you cannot like constantly go up by a lot, it's sort of the stock itself will have a upward pressure point over here. So now the upward pressure point go from $64 to $62, and then you trade it flat for a little bit, and kabam! Somehow, somewhat, everything drops around $60. Okay, people start panicking. Let's just buy up. But by this point, because algos are trading, no matter what you do, there's really nothing else you really can do anymore. So then around like $60, when algo picks it up, they start selling, because the probability of the stock to be over $60 by the end of the market close, when around 11:20 the stock is already at 60, and it seems like a lot of people or a lot of shares of the stock is changing hand. In the algo or quant world, they're probably gonna start selling, right? And also quants are working along the shorts. Their objective is to make sure that the stock doesn't go over 60, because as long as the stock over 60, there's going to be a gamma squeeze, and it's going to trigger a big short squeeze. So what they do is bang, they start selling. We reach $57. People finally realize that, oh my god, the probability of us getting 60 is not that great anymore. They start buying. But all of these efforts are in vain, right? Because this is already like the option expiration day for this week. So you can't really utilizing long options to really do anything for this sort of not settlement cycle, for this option cycle. So what you can do is just keep buying. But because a lot of apes don't really have a lot of cash flow, that's why if you watch Matt or if you watch Trade Stream, right, you will realize that what they're preaching for is you should hold, you should buy and just hold. But the problem is, if you don't have any liquidity, when you get short attacked, you can't really do anything, because what is really moving the market is liquidity. It's the liquidity of how you buy the stock and the liquidity of how you short the stock, okay? So then by the end of the market close, it's not even $60. When it's not $60, that means everybody who bought $60 options, all their money got wasted unless they roll their options, right? But there's a cost, there is an intrinsic cost for rolling their options. That means they still at least lose 50% of their cost, right? Or the cost of rolling the option would be 50% more than if they just buy the next weekly option, if that makes sense. And because the fact that we dropped under the $60 sort of gamma strike line, that means every option over $60, their intrinsic value goes down, and their delta goes down. The probability, their theta value isn't that great anymore. You know what I'm talking about? Yeah, I think there's too much information in this video, so I'm just gonna stop here, and you guys should watch it and digest, and smash that like button so we can beat the YouTube algorithm. And if we reach, let's say, 500 likes on this video, I'm gonna put out a detailed sort of short squeeze look back video on GME and maybe on AMC, because a lot of you really need sort of like an education on what really happened during a short squeeze. And if you can sort of, because there is a 15-day delay on how the SEC reporting stuff, and then they fail to deliver data to us, we can actually use some of the market trends and some of the candle charts to really see what is going on, and what is hedge fund manipulation, what is retail selling, and what really happened during a certain period of time. And because I've already figured out a way to really pinpoint when do hedges cover, how much they covered actually, but there are around 6 or 7 day delay. In my next video, I'm going to talk about the possibility of double squeeze, and I can literally tell you guys the probability of the double squeeze the closer we get to next Friday. And hopefully the hedges don't cover before next Friday. but we don't really know, right? Because the economic outlook isn't as great as we want it to be. But anyways, I think I'm rambling a little bit and there's too much information in this video, and I'm still sort of in a very bad spot because I had a fever last night. So I think this is it for the video. Smash that like button so we beat the YouTube algorithm, and if you haven't sub, and if you think our content is very great, which it is, it's like one of the most premium content you can even find on YouTube, because we actually talk about finance. We don't really just hype you up, right? And we're super honest. So you share our video on StockWiz, on Twitter, on Reddit, share it with your friends, and just sub. Alright, see you guys on the upside.